Decentralized finance, or DeFi, has become a buzzword in the cryptocurrency space over the past couple of years, and yield farming is one of the most popular applications of DeFi. Yield farming allows users to earn passive income by lending or staking their cryptocurrencies in decentralized protocols. In this video, I will provide an overview of yield farming and how it works, so you as a beginner can understand and potentially start to invest in this space. G'day DeFi family, my name is Bruce. Welcome to my channel and welcome to my DeFi life, dedicated to hunting down and documenting my DeFi and crypto investments that may be of help to you on what to do, or more importantly, what not to do when traversing this new financial space. If you're not subscribed, then don't hesitate, as it really supports and helps me and my channel grow. Quick disclaimer to note that these videos are not considered financial advice, and I would expect you to do more research on any of the protocols I cover on this channel. Now let's jump into the topic at hand, yield farming. Yield farming is a way to earn interest or rewards by holding or lending cryptocurrency on a decentralized platform, otherwise known as a DEX. In traditional finance, banks offer interest on savings accounts and other investment products. In DeFi, yield farming is accomplished through liquidity provisions, which refers to providing liquidity to decentralized exchanges in exchange for rewards. The process of yield farming involves locking up your cryptocurrency in a smart contract, which allows you to earn interest on your holdings. This can be done through various DeFi protocols such as lending protocols, liquidity provision, liquidity mining, yield aggregators, and staking protocols. One way to earn passive income in DeFi is by using lending protocols. Users can lend their cryptocurrency to other users on the platform and earn interest on their loan. The interest rates on these platforms can vary depending on the demands for the cryptocurrency being lent. This means that the interest rate can change frequently and may vary depending on the cryptocurrency being lent. When using lending protocols, users can choose which cryptocurrency they want to lend and how long for. Examples of popular lending protocols include Aave and Solend on Solana. Liquidity provision involves adding liquidity to a decentralized exchange such as Uniswap, SushiSwap, or PancakeSwap in exchange for rewards. Users can provide liquidity for trading pairs and earn a share of the trading fees collected on the DEX. The more liquidity you provide, the more trading fees you can earn. This can be a profitable strategy, as DEXs have become increasingly popular in recent months due to their decentralized nature. When providing liquidity to a DEX, users need to provide an equal value of two different cryptocurrencies. For example, if you wanted to provide liquidity for ETH and USDT trading pair on Uniswap, you would need to provide an equal value of both ETH and USDT. Staking protocols require users to lock up their cryptocurrency for a specified period of time to support the security and operation of the blockchain network. In return, users can earn rewards in the form of additional cryptocurrency. For example, users can stake their Ethereum in the Ethereum 2 network and earn the rewards for helping secure the network. The rewards can vary depending on the protocol and cryptocurrency being staked. Staking can be a profitable strategy for long-term holders who want to earn additional cryptocurrency while still holding onto their original investment. Other popular staking protocols include Cardano, Polkadot, and Cosmos. Liquidity mining is a way to earn rewards by providing liquidity to a DeFi protocol or DEX. This is similar to liquidity provision, but instead of earning trading fees, users earn rewards in the form of the protocol's native cryptocurrency. This is a popular strategy for new DeFi protocols that want to incentivize users to provide liquidity. Examples of protocols that use liquidity mining include Uniswap, SushiSwap, and Curve Finance. Yield aggregators are platforms that automatically allocate users' cryptocurrency to various yield farming strategies to maximize returns. These platforms use smart contracts to automatically move users' funds to the highest yielding protocols in real time. Examples of popular yield aggregators include Yearn Finance, Beefy Finance, and Animal Farm. To participate in any of these forms of DeFi yield farming, investors need to have a cryptocurrency wallet and a basic understanding of how to interact with DeFi protocols. There are various wallets that support DeFi protocols, such as MetaMask and Coinbase Wallet. Please see my MetaMask introduction video in the card link above to get started. Once you have a wallet set up, you can connect it to the DeFi protocol of your choice and start earning rewards. Here is a list of the DeFi protocols that provide a range of the discussed yield farming variations. Links in the description below. These are just a few examples of the top protocols that offer yield farming passive income opportunities. It's important to do your research and understand the risk associated with each protocol before investing your cryptocurrency. Compound, a lending protocol that allows users to earn interest on their cryptocurrency deposits and borrow other cryptocurrencies. Aave, a lending protocol that allows users to earn interest on their cryptocurrency deposits and borrow other cryptocurrencies. Uniswap, a decentralized exchange that allows users to trade cryptocurrencies and provide liquidity in exchange for rewards. SushiSwap, a decentralized exchange that allows users to trade cryptocurrency and provide liquidity in exchange for rewards. Curve Finance, a decentralized exchange that specializes in stablecoin trading and allows users to provide liquidity in exchange for rewards. Yearn Finance, a yield aggregator that automatically allocates users cryptocurrency to various yield farming strategies to maximize returns. Harvest Finance, a yield aggregator that automatically allocates users cryptocurrency to various yield farming strategies to maximize returns. PancakeSwap, a decentralized exchange on the Binance Smart Chain that allows users to trade cryptocurrency and provide liquidity in exchange for rewards. Animal Farm is the first deflationary, fully decentralized ownership yield farm lending protocol in DeFi, where participants earn as owners of the network. It has many unique mechanics. The average returns for yield farming can vary widely depending on the specific protocol, market conditions, and other factors. Some yield farming opportunities may offer annual percentage yields APYs in the double digits, while others may offer much lower returns. It's important to note that yield farming is a relatively new and rapidly evolving area of finance, so historical returns may not necessarily be indicative of future returns. In comparison to traditional finance, the returns from yield farming can be significantly higher. Traditional savings accounts and other low-risk investments offered by banks typically offer relatively low interest rates, often below the rate of inflation. For example, in the United States, the average interest rate on a savings account was around 0.05% as of early 2023, which is significantly lower than the potential returns from a yield farming. However, it's important to note that yield farming in DeFi can be much riskier than traditional finance, as the value of cryptocurrencies can be volatile and the protocols themselves can be vulnerable to security issues. As such, it's generally not recommended to compare the returns from yield farming to those of traditional bank accounts or low-risk investments. It's important for investors to do their own research and understand the risks involved in yield farming before investing any funds. Investors should also consider diversifying their investments across different protocols and not invest more than they can afford to lose. And remember, this is not financial advice. So we have some yield farming investment tips if you want to get involved in yield farming. Do your research before investing in any yield farming opportunities. It's important to thoroughly research the protocol, its governance structure, its tokenomics, and any associated risks. Look for reviews and analysis from reputable sources, such as industry publications or well-known analysts. Start small. When you're first starting out with yield farming, it's generally a good idea to start with a small amount of capital and gradually increase your investment over time. This will allow you to gain experience and become familiar with the protocols and risks involved. Understand the risks. Yield farming can be a high-risk investment strategy, so it's important to understand the risks involved and only invest funds that you can afford to lose. Risks include smart contract bugs, exploits, impermanent loss, and other security issues. Make sure you're comfortable with the risks involved before investing any funds. Diversify your investments. It's generally a good idea to diversify your investments across multiple protocols to minimize risk. This can help spread out your exposure and reduce the likelihood of losing your entire investment in the event of a protocol exploit or other issue. Consider using a yield aggregator. Yield aggregators such as Yearn Finance or Harvest Finance can help simplify the process of yield farming by automatically allocating your funds to various strategies to maximize returns. This can be a good option for investors who are new to yield farming and want to reduce the amount of time and effort required. Keep track of your investments. It's important to keep track of your investments in yield farming and monitor your returns over time. This can help you identify any issues or underperforming investments and adjust your strategy accordingly. Remember guys, yield farming is a high-risk investment strategy that requires careful consideration and research. It's important to only invest the funds that you can afford to lose and to do your own research before making any investment decisions. These protocols can be vulnerable to smart contract bugs, exploits, and other security issues, which could result in the loss of your invested funds. Investors should also consider diversifying their investments across different protocols, and in general, it's important to prioritize your savings for emergencies and other financial goals before considering investing in yield farming or any other type of investment. Overall, yield farming is a popular application of DeFi that allows users to earn passive income by lending or staking their cryptocurrency in decentralized protocols.